Balance of trade. Now, a country's balance of trade is the economic value of all the products that it exports minus the economic value of all the products it imports. Now, a positive balance of trade is when a country exports more than it imports, and a negative balance of trade is when a country exports less than it imports. Now, a negative balance of trade indicates that more money is being taken out of the economy, which means less money is available for investments that increase productivity. So a negative balance of trade is negative for a country's currency, okay? And it's negative for the overall economy. Now, every month, the US balance of trade operates at a deficit of approximately negative $44 billion. Now, this is very bad for the US. However, because of the US stock market and because of the overall investment environment that the US provides, the investment environment that the US provides kind of offset the effect of this negative balance of trade. But the negative balance of trade is still bad for a country's currency. So when the deficit decreases from month to month, that is positive for the US dollar, as that means less money is leaving the economy. So we can pay attention to the balance of trade to get an idea of how much money is leaving the US economy. And if we can see a trend in which the deficit is increasing from month to month, this is overall negative for the US and it's negative for the US currency. Okay, if we can see a trend in which the deficit is decreasing from month to month, then this is positive for the US and is positive for the US dollar.